This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Tuesday, September 30th, 2014. I'm Lee Adler. Well, the market tried to get through resistance this morning and failed. I had delineated or looked at the 1986 to 1990 area as key resistance that the market would need to break through in order to end this downtrend. And so far today, looking at the tape, it's been unsuccessful. At about 3 p.m., New York time, they're trying to mount a rally again after the market fell to near the key support level at around 1966. So those are the levels to watch in the short run: 1965-66 on the downside, 1985-90 on the upside, as long as we're in that narrow range in between. There's not much information to be garnered. The 6-7 week cycle up phase looks like it has not doing much so far, and again, to get anything going on the upside, it needs to get above that 1986 area. The 13-week cycle is in a down phase, and it's due to stay in a down phase for the next 5 or 6 weeks. We don't know how weak it's going to be, and that again depends on whether support at around 1965 holds. We don't have any downside projections, but if that support is broken, then the next major support level is down around 1935.40. There's a long-term trend line somewhere in this area around 1960-65. If that breaks, it could also trigger long-term indicator sell signals, which would indicate that we might be beginning a bear market. But until that happens, everything is just on the cusp. So we're just going to have to wait and see whether this is the beginning of a new bear market or not. Back in the beginning of August, the TBAC, the Treasury Borrowing Advisory Committee, recommended to the Treasury that it build a contingency fund of $500 billion. Recent evidence that I track in the Wall Street Examiner Professional Edition Treasury update, including the Treasury balances and the size of the Treasury offerings, would indicate that perhaps the Treasury is beginning to move in that direction, as it has built its cash level from a norm of around 50 billion at this date during the year to over 100 billion presently. So let's take a look at some of that data and see what the implications might be for the economy and the market. This is a chart of the U.S. Treasury's cash balance going back to the beginning of 2013. And the green line here connects the daily balance, which is the blue line, between September 25th of this year and September 25th of 2013. And you can see that there's a dramatic increase in the cash balance. It's more than double what it was a year ago. This suggests to me that the Treasury is taking seriously the TBAC's recommendation that the Treasury build a, quote, rainy day fund of $500 billion to have ready in the case of any budget contingencies, debt ceiling battles, and that type of thing, any crisis that they might need those funds for. This could be the beginning of that. The two factors that are working towards building these balances are increased levels of tax collections, which I've talked about in the weekly Treasury updates, and including withholding taxes, which are up. It's actually trending upwards around 5.5% to 7%. And other forms of taxes are also up sharply on a year-to-year basis. So that's part of it. The other part of it is that, for example, last week the Treasury increased the size of the 4-week bill offering from the forecast $25 billion, which the TBAC had forecast at the beginning of August, to $40 billion. So there's some indication there that the Treasury is going to use any opportunity it can to borrow more cash. So this is evidence that they may be building towards that $500 billion recommended fund for contingencies. I want to take a look at the Fed's balance sheet with you to see if I can give you an idea of how I track the money flows between the Fed, the U.S. Treasury, the primary dealers, and the economy. I can do that each week by following the changes in the Fed's weekly balance sheet, the H41 statement that they publish every Thursday night, virtually in real time for the week ended the day before, on Wednesday. And each week as I watch these changes in the line items on the liability side of the balance sheet, I can get an idea of where the money is coming from and where it's flowing. Now, as you know, if you know anything about accounting, assets equal liabilities plus capital. Capital on the Fed's balance sheet is a relatively small amount and relatively fixed, so that over time, assets tend to equal liabilities on the Fed's balance sheet. They should be almost the same on both sides. So that when the Fed purchases assets under QE, it adds an asset. It adds either mortgage-backed securities or treasuries to the asset side of its balance sheet. But there are equal changes in the liability side. So let's take a look at the liability side of the balance sheet. It's published each week in the H41. Here's the heading liabilities. The first item is Federal Reserve notes, net of Federal Reserve bank holdings. That's basically cash that the Fed trucks out to the banks, and the banks hold in their vaults and circulates through the system. You might have some of it in your pocket. Now that changes a little bit each week, and it's not what we're going to focus on here, but I just want to describe each line item so that you know what we're talking about. The next item is reverse repurchase agreements. This has assumed a little more importance in the last year or so as the Fed has added its tri-party reverse repurchase agreement program, where it takes in excess cash that the banks, money market funds, and the primary dealers can lend to the Fed on a day-to-day basis. They're basically just doing overnight reverse repurchase agreements. So to me, these are the same as cash. They have an overnight term. They're readily available to these institutions to do with as they wish. And again, it's an interesting topic, but it's not the focus of our conversation today. Where we are going to focus is on deposits. And there are several different types of deposits held at the Fed. First, there's the term deposits, which is the Fed's term deposit facility that they run from time to time. It's like a CD that they take from the banks, that they take cash from the banks, and they issue a CD and pay a nominal rate of interest, which is slightly above the interest that they pay on excess reserves. Right now, that total is zero, so we don't need to pay any attention to that. I've ranted about that in the past. You've seen my videos on that. The key item here is other deposits held by depository institutions, and that is essentially bank reserves, $2.7 trillion in excess reserves right now. When the Fed purchases an asset from a primary dealer, whether it be the MBS or the Treasuries directly, it credits their account at the Fed. Now that's a different line item. Let's go down here to other. The Fed does not tell us exactly who these other depositors are, but it's easy to deduce just by following the flows in and out of these accounts. They do say that they include major institutions, systemically important institutions, some foreign entities and things of that nature. But in watching these flows from week to week, I've noticed over the years that they go up dramatically during the weeks when the Fed purchases MBS securities, and then they fall in subsequent weeks. And the amounts tend to be about the same or similar to the amount of MBS purchases. So it's pretty clear that the bulk of these other deposits represent the trading accounts of the primary dealers at the Fed. Now, the Fed purchases its MBS securities throughout the month from the primary dealers, but it only settles them at the middle of the month. These are forward purchases 30 to 60 days in advance of the settlement. And each month from about the 11th to the 19th or the 12th to the 20th of the month, the Fed settles these MBS purchases. So last week was one of those weeks, and lo and behold, what do we have here? You can see that this line item rose dramatically. it went up by $49.9 billion. Now that was mostly due to the Fed's purchases that week of treasuries and mortgage-backed securities. There may have been some other items in there, but most of that was due to those to the settlement of those purchases. So other deposits representing the primary dealer accounts at the Fed rose by almost $50 billion. What's going to happen with that $50 billion? A couple of things. First of all, the primary dealers are going to transact trades with counterparties, and among those counterparties are the U.S. Treasury and other banks, other trading institutions, and their own parent companies. So next week, you're going to see a big drop in that line item. That $57 billion is going to go away. It's going to drop dramatically. Where's it going to go? It's going to show up here in bank reserves. As the primary dealers transact business, that other deposits will decline and the money will show up in reserve deposits. Now, also in the next week, the Treasury is going to sell some more debt. The primary dealers are going to use this cash to purchase that debt from the Treasury. That cash will go into this account, the U.S. Treasury General Account at the Fed. Now, normally the Treasury is going to spend that money very quickly. So, the week before, the Fed purchased securities from the primary dealers. The next week, that's here, the next week, the primary dealers are going to buy treasuries at the offerings, at the auctions, and the money is going to flow into this account, the U.S. Treasury General Account. Okay, that's money that didn't exist 2 weeks before. It's money that the Fed printed. Going to go into the U.S. Treasury account, and in the following week, the Treasury is going to spend that money, and where's it going to show up? It's going to show up here in the reserve accounts of the banking institutions. So that's how, when the Fed prints money, when the Fed buys securities from the primary dealers, it goes from the dealers back to the Treasury, and then it's spent into the banking system, and the money supply inflates. So there, even though the Fed says it's not monetizing debt, it certainly is. It's indirect, but you can see the flows each week on this balance sheet. And I cover it weekly in the Wall Street Examiner Professional Edition Fed Report, where I do a little summary of these flows every week so that you can get a feel for how all this works together. Now, we discussed the fact that the TBAC recommended to the Treasury that it increase its balances that it typically holds. They can be as low as a few billion up to about $100 billion during the middle and end of month period when the Treasury is selling debt. But the TBAC has recommended in its last report to the Treasury at the beginning of August that the Treasury hold much larger balances. It recommended that the Treasury should hold a permanent balance of $500 billion. It's kind of a rainy day fund for any contingencies that might arise. This would include any economic contingencies, any economic crisis that the Treasury may need to spend money. It may include another debt ceiling impasse or any kind of a budgetary crisis. So the TBAC has recommended that these funds be increased. And we saw that in the chart that I showed you just a few minutes ago, that they've increased their balances by almost double already from the typical $50 billion around this time of year to over $100 billion. If the Treasury is intent on holding $500 billion in a rainy day fund that it doesn't spend, what's going to happen is that this total here is going to rise from the current $118 billion to maybe $500 or $600 billion. And it's just going to sit there. That's money that's not going to be spent. So as the primary dealers buy treasuries, as the government collects taxes, and it's doing that at a breakneck pace lately, instead of turning around and spending all of it so that it goes back into the economy and back into the banking system, it's going to hold these funds. And effectively, that's going to reduce this number here. It's going to pull funds out of the banking system, out of reserves, and transfer them into the Treasury General Account at the Fed, where the money will just sit. It won't get spent. That is effectively the same as the Fed draining reserves from the system. If the Treasury takes out $500 billion over the next 6 months to a year, That's money that's going to be sucked out of the economy. It could slow the economy as the Treasury sells additional debt without the Fed's help. Remember, the Fed is going to cut QE to virtually zero. It'll only be buying MBS replacement purchases next year, and that'll only be around $15 billion a month as opposed to a year ago when it was buying $85 billion a month. So now the market's not going to get any help from the Fed. The market is going to have to absorb all of these new Treasury securities that the Treasury floats every month, 50, 60, 70, 80 billion a month. And without the help from the Fed and the Treasury at the same time draining reserves, that could create a little bit of an economic slowdown. Now, there are still going to be about 2.2 to 2.1 trillion in excess reserves in the system. So how that is going to impact interest rates just remains to be seen. It seems to me that if you have excess reserves, it's going to be hard to get that Fed funds rate up from zero. If the Fed begins to pay interest on excess reserves, I don't see how that's going to cause interest rates to rise, because what happens is if it's paying the banks interest on all this excess funding, it's reducing their cost of funds in the process. So I don't see how that'll raise rates. But these are all questions that we'll face in the future if the economy continues to strengthen and the Fed stays its course of reducing QE and eventually pulling the punch bowl. At the same time, if the Treasury is increasing the amount of cash that it holds, that acts as a drain from the system, and we're going to get to see an interesting experiment over the next 6 months to a year or so, if in fact this is their intent. That will do it for today's program. I hope I've made things clearer for you, or at least a little more clear than mud. I wanted to give you some idea how I look at these things and how I analyze them, and hopefully you can follow this along with me for those of you that do subscribe to the Fed report. Now, next week I'll be traveling for a few days on business, so I won't be able to do a program next week. So I'll move the next program a day closer to the following week. We'll make it on Monday, October 13th. So until then, Monday, October 13th, have a great couple weeks, trade sane, and I'll see you then.